Disclosure: the views and opinions expressed here belong solely to the author and do not represent the views and opinions of Crypto News editorial. After years of regulatory uncertainty and a flurry of enforcement actions, U.S. voters have delivered a resounding message: the time has come for a new approach to crypto regulation. This sentiment has been echoed across both executive and legislative branches, with over 292 candidates who openly support crypto elected to the legislature. This wave of pro-crypto leadership has ignited cautious optimism within the industry, bolstered by a post-election surge in institutional and retail adoption that if the incoming administration fulfills its pre-election promises, the U.S. could position itself again as a global hub for crypto innovation. However, the path forward is not without challenges. The European Union's markets in crypto assets regulation, set to take effect on December 30th, will introduce a comprehensive regulatory framework, potentially outpacing the U.S. in offering clarity to crypto businesses. To maintain its leadership, the U.S. must seize this moment to craft a regulatory framework that strikes a delicate balance, one that fosters innovation while safeguarding consumers and investors. This will require moving beyond the reactive, enforcement-first strategies of the past and embracing a more proactive, principles-based approach. Since 2017, the U.S. Securities and Exchange Commission has largely relied on enforcement actions to address perceived regulatory gaps in the crypto industry. This approach, while well-intentioned, has contributed to significant uncertainty. In 2023 alone, the SEC initiated 46 enforcement actions, a 53 increase from the previous year, further highlighting the inadequacy of applying legacy financial regulations to this rapidly evolving space. Recent proposals, such as granting the Federal Reserve authority over stablecoin issuers as depository institutions, demonstrate the tension between traditional regulatory frameworks and crypto's unique characteristics. Stablecoins like Tether and USDC thrive on their flexibility and global reach, attributes that don't neatly align with the requirements of traditional banking regulations. Fortunately, the outcome of the recent elections suggests a shift in public sentiment. Voters are signaling a preference for regulatory clarity and more constructive dialogue between lawmakers and the crypto industry. One of the most notable shifts occurred in Ohio, where incumbent Democrat Sherrod Brown, known for his critical stance on crypto, was unseated by Republican Bernie Moreno. Backed by industry heavyweights like Coinbase, Ripple Labs, and Andreessen Horowitz, Moreno's campaign underscored the growing influence of the crypto sector in shaping political outcomes. With SEC Chair Gary Gensler's tenure coming to an end in January, new leadership at the agency, potentially someone like Dan Gallagher, an advocate for balanced regulation, offers some hope for a fresh approach. Gallagher's experience and pragmatic stance could help bridge the gap between innovation and investor protection. Gallagher's experience and pragmatic stance could help bridge the gap between innovation and investor protection. Brian Armstrong, CEO of Coinbase, remarked that this is America's most pro-crypto Congress ever. This optimism is justified, as Congress appears poised to revisit critical legislation like the Digital Commodities Consumer Protection Act. If passed, this bill could grant the Commodity Futures Trading Commission a more prominent role in overseeing digital asset markets, reducing the SEC's outsized influence and providing much-needed regulatory clarity. While the promise of pro-crypto legislation is encouraging, lawmakers must tread carefully to avoid the pitfalls of overregulation. For example, the EU's MiCA framework has drawn criticism for its systemic risks and the potential to stifle innovation by imposing stringent requirements on certain crypto assets and markets. Similarly, recent moves by French regulators to clamp down on prediction markets, such as Polymarket, underscore the risks of applying outdated regulatory models to innovative technologies. Such actions, while aimed at investor protection, may inadvertently hamper market growth and limit consumer choice. The goal for the U.S. should be a regulatory regime that promotes innovation, encourages competition, and facilitates market access for startups and larger institutions. By fostering an environment of trust and transparency, lawmakers can protect consumers without stifling the entrepreneurial spirit that drives the crypto industry forward. With a historic pro-crypto mandate, the U.S. is at a pivotal moment. The opportunity to reclaim its position as a global leader in financial innovation is within reach, but the path ahead remains to be determined. Success will depend on the willingness of lawmakers and regulators to embrace collaboration, prioritize clarity, and foster an ecosystem that balances innovation with robust consumer protections. As this new chapter unfolds, one thing is clear: the future of crypto in America holds immense potential. Whether that potential is realized will depend on the actions taken in the months and years to come. Manfred Bucharest is an accomplished compliance professional who serves as Chief Compliance Officer at Paxful. With over 14 years of experience in the global financial services industry, he's become an industry expert in anti-money laundering compliance and financial crime prevention for crypto and fintech organizations. He has a proven track record of developing scalable compliance programs, leading global regulatory initiatives, and enhancing compliance systems. Manfred has held senior leadership roles at prominent companies such as Crypto.com, OKX, and Western Union. With expertise spanning SAML, KYC, and sanctions compliance, he consistently helps organizations navigate complex regulatory landscapes while fostering innovation and growth.